For anyone looking to build wealth today, the sheer volume of investment options is completely overwhelming. You open a brokerage app and are immediately flooded with a matrix of acronyms, tickers, and thousands of different financial products. The most common vehicle you'll encounter is a fund. At its core, a fund is simply a mechanism for thousands of investors to pool their resources together. Instead of buying individual pieces of real estate or single company stocks on your own, that massive combined river of capital buys a heavily diversified basket of assets, and everyone shares in the overall results. But these pools of capital are not built equal. Picking the wrong vehicle means navigating a minefield of internal costs and risk profiles that determine whether your wealth actually compounds or gets quietly eroded by the very institutions meant to manage it. Navigating this landscape comes down to understanding one core philosophical divide on Wall Street. You have to decide if you are looking for a fund that tries to beat the market or a fund that is perfectly content to simply be the market. Let's start with the passive approach, the trackers. Index funds fall exactly into this category. They do not employ analysts to guess which companies will succeed next year. They operate blindly, automatically copying an existing list or scoreboard of companies. We call that list an index. One of the most famous examples is the NASDAQ, an index that heavily tracks the performance of United States technology giants. By buying a NASDAQ index fund, your money mechanically follows the exact historical growth trajectory of companies like Apple, Microsoft, and Amazon. If tech isn't your focus, there are indexes for almost everything. The Dow Jones Industrial Average, for instance, tracks 30 massive, heavily established physical industries, tying your investment to the performance of corporations like Coca-Cola and Boeing. Because this tracking process is entirely automated and passive, you aren't paying the salary of a hotshot manager. That keeps the annual fee, known as the expense ratio, incredibly low. You often pay mere pennies per year on a $1,000 investment. This chart highlights the single biggest catch to index funds. You cannot trade them in real time. They operate on a strict end-of-day cutoff system to calculate their net asset value, which is the total value of all assets minus expenses, divided by the number of shares. That means if you place an order to buy or sell at 11 a.m., your money sits in limbo. The transaction will not actually go through until that final net asset value price is calculated after the market entirely closes. You get mathematically superior low costs and high safety through broad diversification, but you sacrifice immediate real-time control over the exact price you buy or sell at. If you want human hands on the wheel, you have to look at the ETFs. Mutual funds pool investor money, just like index funds, but they are actively managed by teams of professionals in massive financial institutions who actively buy and sell assets to try and outsmart benchmarks like the S&P 500. Active management carries a steep financial penalty. Those professional salaries require expense ratios that often jump up to 1.5%, a cost that eats directly into your long-term returns. And the harsh statistical reality is that paying for human intuition usually doesn't work. Decades of data show that the vast majority of actively managed mutual funds fail to consistently outperform a basic passive index. The most extreme evolution of this active philosophy is the hedge fund. These are highly restricted private investment vehicles, completely closed off to the general public, accepting capital only from high net worth accredited investors. Hedge funds are not interested in slowly matching the market. They chase massive, aggressive returns using complex tactics like short selling, betting against companies, and extreme leverage, which is borrowing heavy amounts of money to multiply their investments. This introduces violent volatility into their portfolios. This diagram breaks down their staggering fee structure, famously known as the 2 and 20 model. First, the fund guarantees itself a fixed 2% slice of your total investment pool every single year as a management fee, regardless of whether the portfolio makes or loses money. Then comes the second half of the model. If those high-risk strategies actually work, the fund managers take a massive 20% cut of all the profits they generate. Active management charges a massive premium for the illusion of control. Investors pay exorbitant fees and accept extreme volatility without any guarantee that they will actually beat the standard market. This historical gap between low-cost passive tracking and agile trading led to a modern technological solution, the Exchange Traded Fund, or ETF. ETFs keep the passive, heavily diversified structure and the low fees of a standard index fund, but completely ditch the end-of-day cutoff time. They trade identically to individual company stocks. You can buy and sell them on a standard brokerage app second by second throughout the open market, reacting to conditions instantly and often with zero commission fees. ETFs effectively democratize the market. They combine the automated, low-cost safety of an index fund with the fast, agile machinery of individual stock trading. Looking at this side-by-side performance chart reveals the grand irony of the financial system. Paying the absolute highest fees for expert human management historically nets worse long-term results than paying pennies for a blind mathematical algorithm. Hedge funds and mutual funds do have specific utility, primarily for ultra-wealthy individuals or institutions seeking niche exposure and aggressive risks that aren't available on the open stock exchange. But for the everyday investor, the math is clear. Even Warren Buffett famously advises that a low-cost index strategy makes the most sense for the vast majority of people. Boring, passive, and low effort is mathematically superior. By understanding the mechanics of how these funds operate, you can completely bypass Wall Street's most expensive traps, keep your fees near zero, and secure a stable financial future.